Good morning, everybody. This is the morning meeting for the ARMR report. Stands for Algorithmic Risk Management Research. I'm your host, Brett Rosenthal.
Good morning, everybody.
Oh,
this is the
what's
morning
going on
meeting
there?
for the ARMR report.
All right, start over. Let's try to get to this quick. Got a lot to do. I got a lot to get ready for. I'd like to start off by going over how we like to trade in a gap down situation. So this show is about stock market investing. In case you didn't know, I manage my own capital as well as high net worth individuals. All the assets are run through Interactive Brokers. So I tell you that because the information I'm sharing is information I literally use on the trading desk every day. And one reason I do this every day is to help me get my mind right so I'm ready to trade and I'm ready to invest correctly. You've got to come up with a sound investing plan when the market's closed and the TV's off, and then execute that plan religiously once the market opens. Execute it ruthlessly. Do not deviate. Don't have CNBC convince you of something else. Don't have market behavior convince you of something else. Do your homework, be prepared, and then execute. Algorithms help us execute. So, a real quick reminder. First thing we try to do, and the last thing we try to do whenever we put a position on, whether it be a day trade or a multi-day trade or an investment we expect to hold for years, we try to get ourselves on the right side of probability first, and we have to make sure that the reward is worth the risk we're taking. This is all about opportunity cost of money. We're going to put money in a bunch of different stocks, or a bunch of different groups, or a bunch of different indexes. And we're going to have stop losses on all of them. So at the end of the day, we know what we're willing to lose on a position going in. What we don't know is how much money we're going to make. So I'll give you an example of how I think about this from an investing standpoint. Could I buy a low PE stock in a cyclical business because there's a cyclical upturn? I could. Maybe I get it right. Maybe I make some money on that cyclical upturn in a business that has low barriers to entry, that's commoditized. Do I put money there? Let's assume for the sake of this conversation, my risk is the same in either investment, that investment or an investment with unlimited upside potential, high barriers to entry, more IP than PE, right? More intellectual property designed around the investment. So the potential upside is unlimited. If I put a position on both investments and my stop loss, I'm just pulling this out of a hat. This is not my stop loss. I do other things. But just for the sake of this argument, let's say the stop loss is 5%. Well, we're going to lose 5% on either investment. So we already know what the loss is. So it behooves us to invest in the asset with the greatest upside potential. I don't really care about cyclical upturns. I care about unlimited upside. I care about owning internet stocks in the mid-90s. I care about owning genetics companies at the turn of the century when the human genome was mapped. These are the things that you want to get on. These are the investment themes you want to own because you make an obscene amount of money over a long period of time. Trying to buy Micron technology for the upswing and the downswing and the upswing and the downswing, not really of an interest of mine. I don't care about car companies. I don't care about steel companies. These aren't companies I have an interest in. It's opportunity cost of the money I've got to invest. And my loss is always going to be the same. I want unlimited upside. This is why I'm focused so heavily on the cannabis space right now. The same investing possibilities as internet stocks in the early to late 90s, the genetics companies at the turn of the century, and now we have a story like this unfolding. On a day trading level, I'm always trying to get on the right side of probabilities and statistics. So a gap down, you hear me say this over and over on these calls, a gap down, I'm looking long. A gap up, I'm looking short. I like mean reversion because the probabilities on big indexes tell me that the markets will go back to the volume weighted average price at some point during the day. It's my job to figure out what the right triggers are to get me long. Now, if the market, which is gapping down right now about, I don't know, 1/3%, it's not a big gap. I usually like a move of more than 1% down on the day in the S&P, more than 2% down on the Qs, and then I'm really looking long because it's a win-win for me. If I come into the day with cash and I have huge alpha that day, I'm trying to capture that alpha on a gap closure or a VWAP closure. So this 1/3% decline at the open is not really that much. I'm going to get back to you guys at 12 o'clock. We're going to go over more of our investing themes. We're going to go over more of our stalking the bear theme. This morning call is just to get your mind right. Get your mind ready to trade today if you're a trader. Just because you're a day trader, that doesn't mean you have to trade every day. Hit your pitch. Look for your opportunity. For us, on a gap down, we look for a gap down and go down that creates separation from the VWAP. Then we look to get long on a trigger, which is volume-based. For investors, we're still stalking the bear. I'll go over more of that at 12 o'clock. But what that basically means is we had a strong morning yesterday morning with a weak close. We're having a weak open this morning. The question is, what's the close? If we have another weak close and we have a couple of those back to back, then we can begin to see the paw prints of the bear returning. The indexes are right back at their downtrend. So this is where we're looking for reversals to the downside. If it happens the other way, that's great. Let's break the downtrend and let's have a great 2019. But this is the point right around here, somewhere around these areas and all these indexes, where we should start to see, if we are in a downtrend, we should start to see whatever the morning is, the afternoon should be weaker. And then we'll know the bear's back and we can start to expect a retest of the lows of last year. All right, guys, good luck. I'll talk to you again at 12 o'clock. Thanks for listening.